We're in an extraordinarily complex world right now where we're seeing supply shocks that we haven't seen since possibly World War II, or certainly since the 1970s. We've just had a pandemic and everybody's scrambling to figure out what the hell is going on. Where is this going? Are we going to get a recession? The issue right now is inflation. This is the thing that everybody's talking about and everybody's fearful of. Is we've never seen inflation like this, well, not since the 1970s. So if you look at the chart of CPI now, you can see we're at levels of 8%, which is something we can't get our heads around in this apparently deflationary or disinflationary world. How did this happen? Was this the money printing? My view is that the persistent inflation of the 1970s that you can see on this chart was actually driven by demographics. When the baby boomers came into the population in the largest number in history of, let's say, 30-year-olds all buying their first house, first car, and everything else together, we had a demand shock. We also had supply shocks as well, from the Arab oil embargo in 73, 74, and then going into the Iran crisis in 79. So we had a double. We had a massive demand shock and a massive supply shock. This time around, I think it's different. This time around, we have a supply shock because essentially the pandemic had shut a lot of things down. So that was the supply shocks of trucking and moving goods around and manufacturing, and factories weren't open. And so you had to bid for higher prices to get stuff. And then there's the issue of underinvestment in commodities themselves. So what's happened is, as the world's reopened, we don't have enough ability to produce commodities at scale. Then we throw in the Russian crisis, the war in Ukraine, and we've taken commodities out of the market. It's created this very heady mix that is really scary right now for everybody. So the next chart I've got is the year-on-year rate of change. Everything in financial markets is about rate of change. It's not levels. Now, the rate of change of inflation is still going up, but commodity inflation has been going down and fast for a period of time. That will feed through to CPI. So this is the all commodities year on year. But one of the things we've been talking about is food commodities. So the food commodity chart, people have been talking about global food shortages. We're going to end up with some shortage for sure. A lot is going to depend on this harvest in the West, and also whether they use food as a weapon against Russia or not, or whether foodstuffs can continue to flow as they did even when we had the Cold War with Russia. People really don't want to create this food situation, but we've got problems with fertilizers, all sorts of stuff. But the year-on-year rate of change is coming down. And that means that CPI is going to come down. Doesn't mean your food price is going to get cheaper, but it means the rate of change becomes less shocking. The other part was the supply chain issue that created inflation. And supply chains are starting to ease everywhere. Now we have a situation in China that again makes this world bloody complicated, because we don't know how long the Chinese situation with COVID and the shutdowns are going to last, and what it actually means, whether those pictures of all the ships in the ports of Shanghai are going to create supply chain issues or whether they're more normal. The issue is these supply chain issues caused a behavioral change in manufacturers. What they started to do was build inventories. And inventories meant that they had goods to sell, even if they couldn't get goods into the country. So everyone was forced to hold longer inventories. Now, inventories increase GDP growth. But when you draw them down, i.e. you start selling your inventories and not importing goods, is what you find is GDP growth falls. ISM inventories, these people are saying that their inventory levels are about as high as they've ever been. They've built inventories, and that was a rational thing to do. But if demand slows, then you've got an inability to sell inventory. And you can see the next chart, which is the ISM versus ISM new orders, less inventories. It's suggesting that the level of inventories is too high compared to the new orders coming through. And we're going to see inventory liquidation over time. And that is suggesting the ISM is going to come below 50. Now, it's not turned around yet. So this could be an ongoing situation. We don't know yet. Are we headed to recession or are we headed to a growth shock? My core hypothesis has been a growth shock because it's easier to forecast than the recession. But as you'll see coming forwards, there's a lot of things suggesting a recession could be on the cards. Either way, it's going to change the structure of markets and how we're thinking about things. So the next chart is looking at that inventory to new orders ratio and its relationship with CPI. And what you can see is this last leg of CPI explosion, which was Russia, plus some of the existing supply shocks, while the inventories to new orders in the United States has been coming off. And it's suggesting that we could see a fast turnaround inflation. We saw something similar to this in 2008. Now, if you look back at the chart here, you can see back in 2008, we saw the same thing where inventories in new orders was falling and inflation was rising. It was resolved by inflation collapsing. And I think that is going to happen now too. But what I've said to people is you need to understand what higher prices does to people. If you're not raising wages or you can't raise prices as a corporation, the high prices that you've got are demand destruction. They're a tax on consumers and businesses. So if I want to represent the tax in a different way, here is the gas prices at the pump in the US. We could use nat gas in Europe. There's a bunch of these things that are exploded. Food prices exploded. And what that means that these consumers have had to pay a tax. Their discretionary income has been more used now for the basic goods and services that they've needed. We've seen this in the past when healthcare costs exploded or schooling costs exploded. Both of those are moderated in recent years. But this is a shock that means people spend less on other stuff. We've seen stuff like restaurants rolling over because of stuff like this. So here's a chart that I stole from somebody else. And what they did is constructed a growth tax. This is based on the dollar, oil price, and interest rates. And they look at it versus ISM. Now, this is really concerning. And this is the point I've been trying to get across to people. It's suggesting that the ISM really could collapse. This one's saying it goes to 42, which is a full and decent sized recession. Now, these data series are volatile. It doesn't always go tick for tick, as you can see on the chart. It gives you the general direction and that the probability of crossing 50 is pretty high right now. So I would take that seriously and concerningly that the forward-looking growth is going to decelerate so rapidly that people are not prepared for it yet. So the next chart here is the Chinese credit impulse. Chinese credit impulse has led the world economy for a while because China's a huge part of the global economy. Now we know that China's been tightening credit, and what we saw is a recession essentially in China. Now, Chinese never report negative numbers, but we've got essentially a recession in China, and they're starting to stimulate now, but it leads the world by 12 months. And the Chinese economy suggests we're going to get a full recession in the US. This maps to the global PMI too. Europe is pretty close to recession already. The German forward-looking indicators are suggesting that, and that is again driven by demand destruction of the higher inflation. We're also in Europe likely to see some sort of controls over the use of energy as they struggle with this shift of energy use into away from Russia into other areas. They're going to have this very high period of prices, and I think we're going to see demand destruction and forced demand destruction by shuttering or rationing some of the energy supply to some of the manufacturers. Now, talking about demand destruction, you can see it writ large here. This is residential fixed investment as a percentage of total fixed investment. What it's saying is households have stopped spending on their own houses. Now, most of us in the pandemic spent a fortune on doing up our houses because we were stuck at home and we realized our sofa was crappy and we wanted a Peloton and all the other stuff that we all did, build a new deck and all of that stuff. And that brought us a huge spike in residential fixed investment, which basically forward-led the rise in ISM. That is coming off fast, and we're back down to that 50 level in ISM. That's very consistent in my forward-looking charts. The other issue is the US and most countries are economies of small businesses. These small businesses got killed by the pandemic, but then luckily tax breaks helped them. Now the tax breaks have gone and they've got rising prices and they're picking up that the consumer is not in the shape they were. And now we can see that small business optimism is starting to fade while ISM is still high. Usually, ISM should follow suit over time. So I'm expecting ISM to come down, and I think small business optimism will continue to go lower as well. Something worth watching. But the picture's even more concerning when I look at household sentiment. So households are terrified right now. They're the most terrified they've been since 2008. And I can understand why. You've raised the cost of everything. You've taken away the fiscal stimulus, and people just don't know whether they can cope with this situation. I mean, don't forget, household disposable income in the US, there may be a lot of assets, but people live paycheck to paycheck. They live on credit, and we've seen credit going up and savings going down to try and counteract these high prices. These high prices are extremely recessionary on the consumer, and I think we're going to see more and more of this. And it also happens globally. That same discretionary spending pattern is happening across the world. We've got these aging population, and older people have fixed incomes, i.e. they've retired, they've got a pension. You raise the cost of living on them, it kills them. And I think this is not something most people are factoring in, is the demographic composition, the debt composition, and then adding higher prices is extraordinarily difficult. And to express this in different terms, look at real incomes. I mean, Jesus Christ, this real incomes have collapsed because they're negative because of the inflation rate, and wages haven't gone up as much. Wages have gone up. But again, you need to remember that wages have gone up for those in the workforce. We have a labour force participation rate that's been falling due to demographics for decades, and those people don't bid up wages, they've retired. So they just take the hit to their income. Those people who are in the workforce have got higher incomes, but it's not as much as inflation as the chart shows you. If it's not as much as inflation, that is discretionary spending coming lower. The older generation just got killed, full stop. So net, even with the increase in wages, the total demand in the US economy has not gone up. So I think people are only looking at one equation, which is the wages have gone up. They're not looking at that real wages are still negative, so they don't catch up enough, and they're not looking at the fact that those wages only account for something like 50% of the population because the rest are out of the workforce or didn't get a wage rise. And therefore, there's no net increase in demand. The other big issue is mortgage rates have exploded. We're back to kind of 2006 levels now, and also 2010-12 levels. We've just had, as this chart shows, the largest rise in mortgage rates in history. So we've been inflating people, we've been taxing people due to the inflation, we've taken away their fiscal stimulus, and now their mortgage costs have exploded just when everybody bought new houses over the pandemic. This is not good. This takes away discretionary spending from the economy. And financial conditions have tightened as well, as you can imagine. And financial conditions take a lot of things like credit spreads that have only just started tightening. Now here you can see the year-on-year rate of change of the Goldman Sachs Financial Conditions Index. That's suggesting the ISM is coming down to 50 as well. Financial conditions are increasing. And I think the Goldman one is not as good as using the model including the inflation on commodities and stuff like that that's not included in the Goldman Sachs index. So again, financial conditions are now tightening, and they're getting to levels where we should start to see economic growth suffer significantly.